Foliko Live, Tyler Tucci, former PM of a hedge fund, and now the head of research for Cinerai, and Travis Nixon, myself, data scientist by trade. Thank you for joining us. We're going to be going through a few tickers we like today, but mostly we're doing some analysis right now that's really going to break this case wide open of what's been going on with this market. We're taking a really deep dive into the data for our supply chain constraints and oil prices. And we're going to see how much of a relationship there is between what this dip has been and those two factors alone. Now, think about all the inflation headaches that we've been facing, the Fed having to raise us through the roof and everything like that. That's really coming down to three things: energy, food, and housing. All the inflation mostly comes from those three things. There has been price increases after that fact, but that's mostly been as a downstream effect of those three issues. So the question is, if we can model out what's happening with energy prices and tie that the relationship and get some kind of causal relationship out of that, especially as well as some of these supply constraints, can we better understand what's the future and if we see a sudden move in oil prices or in a lot of these supply constraints, then does that mean that we can really start predicting macro effects in the market overall? I think the Fed has been highly, highly responsive to what's going on in the market and what's going on in people's minds. I mean, CPI print comes out and then Jerome changes his mind over the weekend. I think that is a pretty strong case to make for understanding things on a more broad scale. Tyler, would you agree with this way of thinking?
Yes, absolutely. And that was on Sunday when we talked and kind of started to plan this week. I had talked to you about, I had seen a chart that someone had posted somewhere of basically the inverse spot, the S&P naturally versus gasoline in reverse, i.e. the chart looked like this as the price goes down. And there was basically, it was tracking very, very well. The price of basically as gasoline goes higher, risk does poorly, SPY does poorly. So I spent some time as a strategist on the sell side, spent some time on the buy side, and I know I can make any two lines look like they have something to do with each other if I work really hard. So what is cool to me, and I always say one of the reasons why I work for Cinerai is we have the ability to then say, okay, cool story, but is this actually statistically significant, or is this one of the market bedtime stories that help you sleep at night? So that to me is what's really exciting, and some of the things that I'm pushing for here are, okay, so let's take some of those old market adages and actually pick them apart, and we have the ability and the people to actually perform these studies, and we're going to bring you our findings. I'm pretty sure there's nobody else doing this for free on YouTube. That's absolutely for certain.
So a quick experience as to why this kind of analysis is so important. I worked with a company once. It was right around the 2020 election cycle, and they had this machine that took every open source numeric data set around the world. So all the indicators that every country would publish. Here's how much soy production we had this year. Here's how our wheat index and stuff like that. And they would do a massive correlation matrix on every number they could grab and then put your target in. And so they were showing us like the power of this machine. So they're saying, look, I bet we can predict the US political race. And they put it in this huge machine. And there was a scary relationship of corn prices in Kazakhstan and Donald Trump's popularity. Donald Trump's likelihood of winning. And what they had picked up was a complete BS signal. Like, if you put enough numbers into a soup, something's going to come out with like a scary relevance. But I saw these guys contorting themselves into the weirdest pretzel shapes, trying to make like, well, if you think about it, corn in Kazakhstan is really an indicator.
That is my favorite. Like, okay, so here I have this random spurious correlation. Defend it.
Yeah. Unless Trump is getting his tanning spray from Kazakhstan corn, I don't think there's a tie-in. So,
but this is exactly it. These are the things that we're going to test for fact or fiction. Does corn prices in Kazakhstan really, improve the likelihood of Trump winning an election? Is higher gasoline bad for equities? I'd say, of course, yes, but can we quantify that? How bad? What is a dollar move higher in gasoline worth in S&P spot price, for example? That would be something that I'm hopefully going to have an answer to. We'll also overlay our Foliko health factors in there and kind of see what we can make of that as well. We think our grossed up health factors are very good macro analysts. So we'll get back to you with all that tomorrow. We're very excited about it. I think this is one of the things that we're best at.
The other thing that we've really got to pull out of this is it a leading indicator? And if so, by how much? Because even if this is tracking and there is some causality, but the latency between oil prices and the stock market reacting is like 15 minutes. Like everyone finds out oil prices are charging upwards and 15 minutes later, they're like, de-risk. Then we don't actually have something that we can use. Like it'll be interesting to talk about. We'll still present the findings, but at the same time, does this inform future portfolio moves? Not necessarily, because if you're trying to beat Wall Street with all the resources they have in understanding oil prices and making portfolio moves accordingly, you sitting at your desk, you're just not going to be able to incorporate that much information and compete on that basis. So we're going to want to see at least a 24-hour lead time where you can input this into your portfolio and understand some of your own risk factors from that. But so today's show is going to be really short. We just want to talk about a few things. There is some interesting I was seeing. Tyler and I, right before we went live today, started talking about Zoom and some of the indicators that we have out of that. Now, I want to show you what's happening in Foliko on this. And why I think this is actually going to be an interesting conversation. So in Foliko, oh, were you pulling up a chart, Tyler?
I was just going to leave that up there just to kind of provide context. That's a 4-day candle Zoom chart. Maybe I'll just turn it to daily to show some people, everyone, what they're more used to seeing. That's a 821 EMA cross, and it's moving lower. And that was kind of what we, to tee you up, we're concerned about, where intellectually we like Zoom, but my charts don't like Zoom. Foliko kind of has an indifferent view of Zoom. So, what are we going to do here?
Yep. Yeah. So, and I want to be really clear to all of our viewers. I am not going to be buying Zoom after this presentation. I just thought that this was an interesting thing to analyze and give you a perspective of what it is we're looking at. Now, there is some kind of case to be made, though, that Zoom could be an interesting purchase in the near term. Our models are looking at this shape, and we're seeing something happening here. It's moving sideways, but if you can catch that volatility between the bands, then I think that you can make a little bit of a pop in your portfolio, hold it for a few days, catch that pop upward, and then make sure you get rid of it before it's about to pop back down. We're not seeing any kind of midterm strength, so there's not really a good case to be made that this company is going to be transforming and making its internals different. So now it's a good investment. But I want to show you what we're seeing on a health factor basis. It's almost a complete meltdown. How well this company is competing with other folks it's really in trouble. And this makes sense. The pressures they're seeing. I mean, if you compare Zoom on a business productivity stack with Slack or Teams, it just does not match up at all. Like Zoom, you can set up some video calls, but is that going to scale to meet everything an enterprise needs? It has so far done better than people expected, but I still think it's holding on to value that it extracted from the 2020 lockdown and remote work that has yet to disappear from it. So I think that that's a lot of the things we're seeing here in this deteriorating competition score. If you look there, it's been a roller coaster with something that's really going down quite rapidly here. But you look across the rest of these health factors that we have, and it's a similar story. One thing here that I do like to see is management. Management has been holding roughly still, maybe a little bit of a degrade lately. But when we see a stock like this is not something that I want to own. I might trade it. And that's the nice thing about Foliko is you're getting that trade signal. But as far as an own signal coming out of management is an indicator for, do I want to own this? And Zoom, I'm going to say absolutely not. Do I want to trade it? Maybe. Thoughts on this, Tyler, as we're going through this?
So yeah, I think that's the right approach. It's an ARC name, so it's got that component in there as well. It'll perform as a function of the ARC portfolio in addition to just as itself. And technically,
get out.
So technically, I see kind of like 65 as the ultimate support level. I don't. It's just not. Again, like we were talking before, it's just not one of those that I look at and I'm like, yes, I need to own this here now. It's cheap. That's just not. Like I say, there is a, I could lose two fingers and there'd still be a handful of stocks that I'd like to buy and hold here.
Mm.
But aside from that, and that's ultimately my problem, and that's I feel, to be quite honest, I feel bad. I missed a 500 point squeeze in SPY because I was so focused on the reshort. So that's kind of my problem here. Is now I'm caught where I think the reshort is the prudent thing to do. I'd be selling this. I'd be selling ARK. I think it's time for another leg down. But I've also been wrong for 500 points. So
what do you make of the Fed minutes being released?
It's the two-handed economist, right? On one hand, but on the other hand, they simultaneously talked about being afraid of the public not believing their resolve to crush inflation while simultaneously being concerned about overshooting. Like, so if I've been doing this, reading Fed minutes almost a decade at this point. I'm pretty good at understanding what they're trying to say, even if they're not saying it well. And I have absolutely no idea what they were trying to communicate yesterday. They're going 50. It sounds like that much. I'm pretty sure they've teed up is 50 next meeting. We're not going to do 75, which is interesting.
That in and of itself quite a sign, though?
Yes, and that's the weird thing, because they've been talking all that good stuff about, we won't quit, and inflation's still running at 8.5. I could point to some problems in the last inflation report that it's not like a clean across the board reduction in inflation. We'll be like, all right, we're trending in the right direction. There's a whole bunch of hair on that. So I'm as confused by this Fed as I've ever been, just because they are so overt about saying they want to crush inflation, but we had a 50 bip drop in CPI last month, and it's already mission accomplished. I mean, to be fair, 50 bips is a powerful hike. They've just been feeding us 75, so relatively 50 looks like it's less, and it is. But if you look at historically the way that the Fed hikes versus cuts, they hike slowly and cut rapidly. So this rapid hiking is a very interesting experiment. And the interesting thing is monetary policy lags, right? So it probably will be a couple quarters until we kind of see the shudder of, because I think it's almost as much a rate of change issue in the rate as it is a outright rate level, because they ripped it up there pretty quick. I mean, terminal in a year, that's historically that is pretty speedy. Usually it takes at least a couple years to kind of get there, but like to already have hiked to terminal pretty much in 12 months, they are backing up somewhat what they're saying. It's not like they're just walking it up at 25 bips and swearing that if it gets bad, they'll be more aggressive. They have been more aggressive. So that's really, I need more direction from Powell, honestly. They're going to go 50, and then he's going to kind of tell us what the plan is. Basically, like I said last week, the entire market, and I mean all of them, is basically hiking or cutting in 2023. That's the trade, is the 2023 euro dollar either steepener or flattener. They're going to be hiking. They're going to either be not cutting, and that's the other interesting thing, is for you to win that trade, the Fed can do nothing in 2023 and you win that trade large. Like, I think there's almost a full point there. And that's kind of what I think that they're going to do. I mean, I just don't see how, unless things get really bad again, then of course they'll start cutting. But until then, I'm not really sure, absent a rapid drop in inflation, right? Like if the month over month prints start to go negative, okay, the game's afoot. But even at flat, even if we get, I think if it's the next 4 prints are 0 month over month. I think we get to like 6.8, which is still wildly high, by the way. So, obviously better, but 6.5% CPI, and the policy rate's at 4. That's probably going to need to get, at least 5. So that's the question is, I just don't believe that the Fed can kill inflation without, they're going to have to cause some turmoil. That's the way out here is through the portfolio, the opposite portfolio balance channel effect is really what they've done the last 10 years. They're just going to have to reverse it and destroy some of that wealth. And, that'll be the fastest way out.
Tyler, here's something I don't understand though. The Fed has this big lever that says slow down the economy, right? They're basically driving a trolley with one lever in it, right?
Yes.
It's the trolley problem constantly.
Yes.
But they've been pulling the lever, slow down the economy. The economy hasn't really slowed like at all. Like unemployment is sitting historically low, right? I'm not seeing really the effects trickling through the economy of these rates being higher. So is the Fed's doing all these things? They'll raise 75 bips and then the next day the market's up and we don't ever see that backlash. Is there some kind of pent up looming economic disaster coming for us that we just haven't felt yet? Or is this just something that for some reason it's getting eaten up by whatever market dynamics are out there right now, and we're just never going to feel this?
It is certainly strange because the traditional way I think about the Fed breaking things, they hike a ton, the dollar rips, the dollar breaks something generally abroad because it's very uncomfortable when the dollar's ripping for non-dollar based dollar borrowers. So that becomes very painful. But this one's been kind of weird because so the mortgage rate just doubled basically, and housing's slowing, but it's really more slowing in the places it was just burning hot. Like, for example, Austin, Texas is coming back to planet Earth, right? It's not, there was a period where, places like DC, places like Austin, where if you came and just offered the ask, it was offensive. So that's right. Like, you just my asking price, how dare you? And now we're back to kind of, a regular market. But
my in-laws sold their house in DC, and they said that they after 24 hours they said, sorry, if you're not bringing in a cash offer, we're not going to consider.
Right. It was that's a question for another day. I have a housing question / thesis that we'll look at. Basically, is this just a dip before just an ungodly rip for the next 5 years in housing? But we'll get there some other day. But basically, it's weird because housing's doing, net not amazing, but better than I would have expected given the mortgage rates, 7. Rents are ripping.
Housing seemed to have plateaued. And when it plateaued, I said, oh, goodness, here we're at the top of the peak. Now we're going to see it. But I haven't seen that follow through down.
And that's
The Economist came out with a big article on this. Their thesis is we're still underhoused in the United States. We're still short about 3.5% of the total housing required to meet demand in the country. And because we're underhoused, we're not going to see that alleviation. So their point is we are going to see rising rents like we would normally in a housing downturn, but we're not going to see decreasing ownership costs, which just means another layer of higher costs for people.
Yeah, right. That makes, and that's the problem, right? Is now no one can afford a house, and rents are just going to be ripping higher. So that's the weird thing is I can't wait because it'll be it won't necessarily be good, but the markets person and the person who is fascinated by how economics works is just going to be fascinated at how this is going to figure itself out because it just doesn't seem sustainable.
Well, what's happening in our economy? I feel like I've worked hard. I've earned a decent living. Okay, I can't. If I tried to buy the house that I'm currently living in, I could not afford it now. We got in right before housing prices just went crazy. I couldn't afford to live where I'm living. So I don't understand. How are all these people coming in with 1.5 million cash offers? Where is that coming from?
Yeah, no, that's another great question, especially in the absence of inflated crypto valuations, because for a while that was just the blanket statement, right? Like, oh, where'd you get the money to buy all your dumb stuff? Oh, I'm a crypto bajillionaire. Oh, okay, cool. But yeah, no, I mean, it's not. There are definitely pockets of the economy that are doing well, but I wouldn't classify this as a an out and out boom. That's absolutely for sure. Um, and that's, yeah, it's just such a weird chessboard set up to kind of play, because none of this, most of this has never happened before, right? I mean, this is the first time that the Fed's going to reverse. Basically, we did helicopter money. We finally did it. In COVID, that was as close to helicopter money as I think maybe we'll ever see, because now they know what happens when they use the money hose on everybody and not just rich people, right? Like, I probably wasn't supposed to say that out loud, but I don't think we're gonna ever see like these handouts like that ever again.
Or we're going to see more of them. That's my alternative hypothesis, because what we've seen is everyone got money and then there was wealth destruction through a whole bunch of market loss, right? And so
and inflation, right? I mean,
I've already heard the case being made. Ignore the inflation part, focus on the wealth loss for the wealthy, and we just figured out redistribution.
Right.
I've already been hearing that, which is ridiculous. It's wrong. It's dumb, because inflation is the higher tax and it's regressive, right? But I think that we're going to see this as a proposed instrument in the future.
It just depends on how the will of the people who are under the inflation, right? I think this is the first time that U.S. has ever experienced like real inflation, where it's like, oh, okay, like, my grocery bill was $100 last week and this week it's 140, right? Like, where it's not like, oh, okay, this cost 3% more this week and it kind of stayed at that price and it's a one-time adjustment and I don't love that, but okay, fine. But no, I mean, price is running away from you every week, and it's obviously has stabilized somewhat, but at higher levels. So that's the other thing that I don't know how appreciated it is how sticky this inflation is going to be and how willing it is to go back down to 2%. A lot of people hiked prices for services, and you don't then go back to your clients and go, okay, it's going, that thing only goes one way. It only goes up. You either leave it flat or you adjust it up. So I think there's a lot of that. I think the cost of services in general went up in the last 2 years. And I think, absent some nasty economic destruction where we kind of have to start over, they're going to stay up. Not wildly up, like inflation's not going to be 10 in the US like that, but we could have, well, that's a whole different set of freaking problems.
What is going, is that America sneezes, Europe catches a cold, or is that something specific to the UK happening?
A little bit of both. It's just, honestly, the UK is in the best situation of the European countries because at least they control both monetary and fiscal policy. They're terrible at it, but like, at least in theory, if they were able to effectively implement policy, they have both levers to pull, so you can actually accomplish things. Whereas the ECB is like, okay, we're in charge of the monetary lever. All the countries get the fiscal lever. You can't coordinate anything. You can't impose anything, because if you want
a disaster on both fronts,
right? It's why ultimately I don't know how viable it is, and people have been talking about this forever. Nobody cares about it. I mean, this is the most macro fail topic ever, because yes, of course, ultimately something will have to go wrong there, because it just doesn't work where if you're trying to impose tighter policy conditions on someone and they go, oh, check out this, tax cut because you can't stop us on the fiscal side. Not great. So I do think it's honestly, I'm not a buyer of any of those European stocks. It's all, complete disaster. They've spent the last 10 to 20 years putting themselves in really kind of an awkward position where they have outsourced pretty much everything, right? So like if you buy the German ETF, for example, or the Italian ETF, like what are you buying? Like what's the company in there? You're like, okay, yeah, awesome. Like this is like, you know, the crown jewel of this country. Like it's just not there. And that's why if you look at a chart,
Ferrari and San Marzano tomatoes, Tyler.
does San Marzano tomatoes have a ticker? If San Marzano ticker,
Cento, who makes that? Anyway, so one thing I did want to say though, and by the way, for all our viewers, we're just informally talking today. This is just an interesting conversation. Hope you enjoy it. This is a little different from our normal episode format.
We only planned like going 10 minutes, by the way. We just
yeah.
Sometimes this is interesting, right?
Yeah, but I do want to say the big shift that I think that we're going to see permanently in our economy is I think that people's views of the value of advertising companies whose main revenue source is advertising, I think that view has changed. And the reason why I think that view is you look at all these social media companies that have been monetizing eyeballs, and the value of eyeball has gone down. Not that in the good times you're not going to make money. Sure, you're going to make money, but I think that this is a high beta asset to have and to monetize as a company. In the downturn that you're seeing like this, there's a stack ranking of risk on these eyeballs that you're monetizing, and I think you're going to lose all that lower tier very, very quickly. Look at what happened to Snap. Look at what's happening with a lot of these companies that rely on capturing people's attention and then monetizing it through ads. And I think we've learned you've got to actually produce something real. You can't just monetize an eyeball. You also, for so long, the social media strategy has been attract the young generation, and then that's going to be the cool thing, and then that's going to filter up to everyone else. Well, it turns out the first generation to be considered worthless in a down economy is that young generation that's not spending any money. So you might be investing on being cool in the future, but your current asset is zilch. So I think that has been a sustained crash in this market that we're probably never going to see back again. I think that investors are going to have to reconsider how they weigh eyeballs.
Yes, absolutely. Eyeballs don't spend any money.
Yes. Yeah. Anyway, Tyler, we need to get running, but you were looking up something specific to the San Marzano.
I couldn't find anything. If we find it, I'm gonna probably buy it no matter what. It'll be in my PA forever. So I'll let you know.
What happened though? I remember maybe 10 years ago buying Prego and thinking like, this is good stuff. And now San Marzano came in, and if you eat a tomato that's not San Marzano, you're like, what am I doing? Like, there's only one kind of tomato that's valid anymore.
Yes, if you're making sauce, there's except no substitutes unless it's from the garden.
All right, everybody. Thank you for joining us on this more rambling format today. But look, tomorrow, not at 8:30 a.m. We don't know what time of day because we want to bring you this exclusive content as soon as we can make it right. So we're going to bring you that show tomorrow. It's going to be on the correlation and hopefully causation between oil and input prices and the stock market where we're at. And that will hopefully inform portfolios as to where we're going to be going in the future. So thank you all for joining. We'll see you tomorrow.